Welcome to Online Trading Campus and welcome to our unique OTC Futures course. Let's continue with our Module 5, Expert. In Lesson 4, we will cover correlations in the futures market. What is correlation and how do we benefit from it in futures trading? To be an active futures trader and to recognize your exposure, it is essential to understand how different futures markets move in relation to each other. I will show you how to eliminate double exposure by using two different correlation tools. I'll go over some of the strongest market correlations and inverse correlations and their uses to help you gain an edge. On top, I will demonstrate how these correlations help reducing risk through diversification and increased probability of success when existing correlations are used to enter a trade. I will also show you how interlinking our supply and demand strategy with existing correlations will help our decision-making process and give us further confidence when entering a trade. Each day, the futures market is impacted by events that cause traders to react in dramatic fashion. These responses quite often will have a ripple effect that can stretch across all types of markets and asset classes. In other words, what happens in one market will in turn move another related market. For traders, it's important to understand this relationship. This relationship can take two directions: positive correlation, two markets move in the same directions, and negative correlation or inverse correlation, two markets move in the opposite direction. But there's one major caveat about this topic. Correlations exist until they don't exist. Correlations usually hold. However, there are times when what seems to be a strong correlation between two markets breaks and no longer works. This is often a temporary phenomenon, as strong correlations always revert back at some point of time. Let's explore our first tool where we can find existing correlations: the MRCI correlation matrix. The link to the website you see here. To understand the numbers inside the table, you have to be aware of the correlation coefficient. Let me explain. The correlation coefficient measures the correlation between two assets. It is a statistical measure between the two asset variables that ranges between -1 and 1. The lowest correlation two assets can have between each other is -1, meaning as one of the two correlated assets moves up, the other moves down in the same degree. This is a perfectly negative correlation or inverse correlation. The highest correlation two variables can have is 1. This is a perfectly positive correlation, in which assets will move in the same direction to the same degree. While the mid-range of the correlation coefficient 0 means that two assets do not have any correlation. The red and green highlighted numbers are correlation coefficients of futures markets that are either highly positively correlated or highly negatively correlated. Green being a correlation coefficient of 0.9 or greater, so 90% or greater. While red is a coefficient of -0.9 or lower, so -90% or lower. In the top left corner, you can see that equity markets all have a very high correlation with each other, such as the Dow Jones Futures Market YM and the S&P 500 Futures Market ES, that have a correlation coefficient of 0.97 or 97%. Hence, this is the strongest positive correlation you can get, meaning they literally move in the same direction, behave like one single market. Hence, if you go long or short YM and ES at the same time, you have double the risk in monetary terms, because it is literally the same trade because of the strong positive correlation. While on the other hand, the Euro futures and the US dollar futures have a highly negative correlation coefficient of -0.94 or -94%. Hence, they have the strongest negative correlation or inverse correlation. Hence, if you go long Euro futures and short dollar index or vice versa at the same time, it is again like you would trade the same market twice and double your dollar risk. So you can also manually change the correlation time window on top of the matrix, you can select any time period from 30 days to 180 days. So this is MRCI. What we are also going to consider is a tool that's available online on the CME website called the Cross-Asset Correlation Tool. So what does this tool do? The Cross-Asset Correlation Tool provides users with a means of visualizing pairwise correlations across the major CME Group products. Similar to the MRCI matrix, the pairwise correlations can be a helpful indicator to identify the degree to which two products are varying similarly over the specific time period. If you go to the CME Group's website, you can use the displayed link. One of the tools that's available for you to view is a tool called the Cross-Asset Correlation Tool. And it takes into account the pricing and trading behaviors between the major CME futures products listed across both the vertical and the horizontal axis. If you look at the Japanese yen futures, which are designated on this table as 6-J, which is their CME clearing symbol, and ES, which is the symbol for E-mini S&Ps. You will see a negative correlation on the day that this was created of negative 0.72. That's a recent high negative number in terms of correlation, or the negative correlation between the Japanese yen futures and E-mini S&Ps. And the negative correlation implying that if one goes down, the other has a greater chance of not going with it, or in other words, working in an inverse relationship. If you look at this tool and you click on that red box, the one that is in this particular case that's labeled negative 0.72, it pulls up another window. This allows you to bore down a little bit more into the details of the correlation relationship. And in this case, the correlation history tab that I chose shows you in recent history how the correlation has behaved. And you can see it's gone from a negative correlation 72 in February 2020 all the way up to its current location, which is negative 38. So you are looking from an historical standpoint as well as a current market condition standpoint at a relationship that changed from a rather strong inverse correlation to a more independent behavior. So why is that? This is an interesting phenomenon that we can see during times of high volatility. In February 2020, we had the Corona market crash. Hence, we had immense volatility across all markets. During times of high volatility, markets in general across all asset classes tend to be more correlated or inverse correlated with each other. So we are more in danger of double exposure in case we traded both markets, S&P futures and Japanese yen futures. So bottom line, we have to be aware of the volatility in the market and check the strength of the existing correlations accordingly to avoid double exposure. Because basically going long S&P 500 and short yen futures or vice versa in February 2020 would have been the same trade. So let me now show you some of the major correlations and explain you why they exist fundamentally and how we can trade them. The first inverse correlation we'll go over is the one between stocks and bonds. For stocks, we'll use the S&P 500, the right chart, against the 10-year Treasury notes futures to do the analysis. This is a simple risk-on versus risk-off correlation. What is meant by this is that theoretically, stocks are inherently riskier than bonds, and therefore, when stocks are moving higher, investors generally have a bigger appetite for risk and would sell the lower yielding bond market. This changes, however, when things get rough in the stock market. Investors seek the safe harbor of treasuries, and in order to raise the cash necessary to purchase these fixed yielding instruments, they sell their stock holdings. The two charts illustrate these inverse correlations. We can see that major inverse moves happen pretty regularly in these two markets. The key for us is to find both markets entering opposing zones simultaneously, thus increasing the probabilities of timing the turning points. This inverse correlation is important if we trade the stock indices or treasuries, because we can use the strong inverse correlation as a zone qualifier. Identifying the quality supply and demand zones is the most important element of this equation. If price simultaneously enters a quality opposing zone, we are allowed to enter a trade in one of these markets depending on our overall analysis. There is normally an inverse relationship between the value of the dollar and copper, and in fact with commodity prices in general. The prices of commodities have historically tended to drop when the dollar strengthens against other major currencies, and when the value of the dollar weakens against other major currencies, the prices of commodities generally move higher. This is a general rule, and the correlation isn't perfect, but there is often a significant inverse relationship over time. The primary reason the value of the dollar influences commodities prices is that the dollar is the benchmark pricing mechanism for most commodities. US currency is the reserve currency of the world. The dollar tends to be the most stable foreign exchange instrument, so most other nations hold dollars as reserve assets. When it comes to international trade for raw materials, the dollar is the exchange mechanism in many, if not most cases. When the value of the dollar rises, it costs more dollars to buy commodities. At the same time, it costs a lesser amount of other currencies when the dollar is moving lower. Another reason for the influence of the dollar is that commodities are global assets. They trade all over the world. Foreign buyers purchase US commodities such as corn, soybeans, wheat, and oil with dollars. When the value of the dollar drops, they have more buying power because it requires less of their currencies to purchase each dollar. Classic economics teaches that demand typically increases as prices drop. Commodity prices don't necessarily tick higher for every tick lower in the dollar index, but there's often been a strong inverse relationship over the long haul. Individual commodities have fundamental supply and demand characteristics, so they move one way or another at times regardless of the direction of the US currency. Since the beginning of 2016, the chart of the yen futures looks like a mirror image of gold. Or in other words, the chart of the USD JPY spot forex has a strong inverse correlation to gold. This has led to a whole host of news articles and research reports with all sorts of different conclusions. The most commonly proposed explanation for this high correlation is that both the yen and gold are safe haven assets. Therefore, so the argument goes, when investors attempt to exit the dollar in search for safety, they buy gold and yen, and thus the two move in line with each other. In reality, fundamentally speaking, there's no proper explanation to this, although the fact that gold and yen both share the status as a safe haven does in a way validates this correlation. Aside from its role as a metal or a commodity, gold is one of the oldest means of exchange known to the human race. In fact, gold has a dual role as both a commodity and a currency. The fact that governments all around the world hold gold as a foreign exchange reserve highlights the importance of the metal. Throughout history, many governments used gold to back their currencies, creating a gold standard. However, today, while governments maintain hoards of the yellow metal, none uses it to back their paper money. The US dollar is the benchmark pricing mechanism for the yellow metal. Therefore, there's a special relationship between the price of gold and the value of the currency of the United States. Gold is an asset. As such, it has an intrinsic value. However, that value can fluctuate over time, sometimes in a very volatile fashion. As a rule, when the value of the dollar increases relative to other currencies around the world, the price of gold tends to fall in US dollar terms. It is because gold becomes more expensive in other currencies. As the price of any commodity moves higher, there tend to be fewer buyers. In other words, demand decreases. Conversely, as the value of the US dollar moves lower, gold tends to appreciate as it becomes cheaper in other currencies. Demand tends to increase at lower prices. Interest rates, by the way, also affect the price of gold. Gold does not yield interest in itself, therefore it must compete with interest-bearing assets for demand. When interest rates move higher, the price of gold tends to fall since it costs more to carry the metal. In other words, other assets will command more demand because of their interest rate component. There's also a psychological factor attached to the value of gold. The price of gold is often sensitive to the overall perceived value of fiat or paper currencies in general terms. During times of fear or geopolitical turmoil, the price of the historic metal tends to rise as faith in governments falls. During times of calm, the price of gold tends to fall. As perhaps the world's oldest and most storied currency, gold is an important barometer in terms of global economic and political well-being. The Canadian dollar and crude oil are strongly correlated. This means they are often likely to move in similar directions to each other. But what are the reasons for this relationship? The reasons for the correlation includes Canada's status as a leading oil exporter, supply and demand considerations, and the revenues in US dollar that Canada enjoys as a result of its exporting activity. Canada is the fourth largest exporter of crude oil in the world, according to 2018 figures. Due to the country's status as a net exporter of oil, its currency in relation to US dollar is highly correlated to oil prices. Supply and demand is also a key influencer of the correlation between crude oil and Canadian dollar and relates to the demand and supply of both Canadian dollars and US dollars. Exports of crude oil account for a large percentage of US currencies earned by Canada, meaning shifts in the volume and price of crude oil have a significant impact on the flow of US dollars into the Canadian economy. High crude oil prices also mean higher US dollar earnings for Canada on its exports, meaning a strong supply of US dollars flowing into Canada, resulting in an increase in the value of the Canadian dollar. Conversely, when the price of crude oil is low, the supply of US dollar will be low relative to that of the Canadian dollar, resulting in a decrease in the value of the Canadian dollar. The US dollar index, also known as just dollar spot index, measures the performance or value of the US dollar against a basket of foreign currencies. The index itself is published by the Intercontinental Exchange ICE and was first developed in 1973 by the Federal Reserve. At the time, it was designed to help view how the US dollar was performing relative to the currencies of America's key trading partners, which included the Eurozone, now the Euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. However, the weighting of each currencies within the dollar index is different. According to the ICE FX index methodology calculation, the currency weighting is as follows. Euro 57.6%, Japanese yen 13.6%, British pound 11.9%, Canadian dollar 9.1%, Swedish krona 4.2%, Swiss franc 3.6%. As you can see, the index is heavily weighted towards the euro currency or the euro-US dollar exchange rate. It will become immediately apparent that the index is heavily influenced by the euro. This gives us the first clue as to how the US dollar index can be useful for making trading decisions. When the euro loses values, this means the dollar index gains value. The nearly 60% average weighting means that the euro-US dollar pair and the US dollar index are inversely correlated. Armed with this knowledge, the US dollar index becomes an excellent indicator for the euro-US dollar and other major pairs. Again, what could be a rule for us when we have these strong correlations or inverse correlations? The key for us is to find both markets entering opposing zones simultaneously, thus increasing the probabilities of timing the turning points. This inverse correlation is important if we trade the euro, dollar index, or even other major currency pairs, because we can use the strong inverse correlation as a zone qualifier. Identifying the quality supply and demand zones is the most important element of this equation, of course, again. And if price simultaneously enters a quality opposing zone, we are allowed to enter a trade in one of these markets depending on our overall analysis. So what is the overall takeaway from this? Let's summarize. We have to be aware of existing correlations and inverse correlations. We can always cross-check the correlations and its current strength on the MRCI or CME group website. If you recognize a strong correlation or inverse correlation, A, avoid double exposure, and B, use it as a zone qualifier as discussed in the S&P 10-year Treasury note example and Euro-Dollar index example. Correlations by itself can never be your primary analysis tool. Use it as a zone qualifier to increase your odds. That's it for this module and the entire futures course. If you require more information on a certain topic, please don't hesitate to ask me in class.